Picking stocks that make you money can feel like finding a needle in a haystack. Where you actually start, you might feel overwhelmed, you might doubt if you have the skills to be able to do it, and you might know people who have lost all their money in market crashes. It's scary. I've been studying world-class investors for years, and what I've learned is that picking stocks can really be boiled down to a step-by-step process that works. So in today's video, I've taken the juiciest insights and put together a step-by-step process from a book called One Up on Wall Street by Peter Lynch. So let's get right into it. Step 1, which is don't make the most common stock picking mistakes. Avoid them like your life depends on it. This is a really important step because if you fall for these traps, none of the other steps I share will matter. The chances of you picking high quality stocks that make you money will be next to zero if you make these mistakes. So what are the common mistakes that people tend to make which you should avoid at all costs? Number 1, attempting to time the market. Lynch says that attempting to predict market movements with any degree of accuracy is nearly impossible. Number 2, focusing on short-term performance or quick money. Lynch says that investment success should be measured over years, not months. And finally, following the herd. You might hear a new AI company that everyone is talking about or some companies making the news. So you pick it and buy that stock based on hot trends versus your own research and analysis. So once you have the right mindset around investing, step 2 is to conduct a 2-minute drill. Peter Lynch shares a quick method for evaluating a stock's investment potential. If the stock passes the 2-minute drill, then it's worth investigating further and going deeper with your analysis. I'll get into the deeper analysis in a bit. In the 2-minute drill, you're going to assess these 5 things. Number 1 is competition. Does the company have a sustainable competitive advantage? 2, debt levels. Does the company have manageable debt? 3, earnings growth. Are earnings growing consistently? 4, insider ownership. Do insiders own significant shares? And 5, the PE ratio. PE ratio is a ratio reasonable given the company's growth prospects. So I've made a video explaining all of the key ratios that I use to evaluate a stock. I'll link it somewhere here, and if you're interested, you can take a look at that video. So the 2-minute drill is super important because it saves you hours and hours of research. If a company doesn't meet the criteria of the 2-minute drill, you can pass it on and say no quickly. After completing the 2-minute drill, step 3 is to focus on stocks you're familiar with. This is a theme that Peter Lynch shares with many stories in his book. He encourages us to focus on industries and companies that we're familiar with. This knowledge provides a solid foundation for developing a thesis. Lynch talks about how we as ordinary retail investors have advantages because we encounter businesses in our everyday life. He gives a story about Dunkin' Donuts. He got interested in the stock because he observed long lines in Dunkin' Donuts, which indicated a lot of demand for their donuts. So you've conducted the 2-minute drill. You narrow down your list of stocks to the ones you're familiar with. The next is to develop an investment thesis. In this step, you're researching at a high level, think big picture, rather than getting into too many details. So in this step, you're answering 5 key questions. And again, these questions are from Peter Lynch. I haven't made this up, but often when I compared what I do to what this book says, it was remarkably similar. So the 5 questions to answer are: what does the company do? Understanding the company's core business operations and products is fundamental. Lynch advises investors to be able to explain the business in simple terms. Number 2, how does the company make money? As investors, we need to understand the company's revenue streams and profitability. Lynch emphasizes the importance of knowing how the company generates cash flow. The third question in developing our thesis is: what is the company's growth potential? Assessing the company's growth prospects is crucial. This includes understanding the market size, potential for expansion, and the growth drivers. Number 4, what are the risks? Identifying the potential risks and challenges facing the company helps investors gauge the downside. Lynch advises considering both internal and external risks. And number 5, why is the stock undervalued if it is? Determining why the market has not yet recognized the stock potential is essential. Lynch looks for companies that are overlooked or misunderstood by the market. Now that you have an investment thesis, step 5 is to validate your investment thesis. This is where thorough research and analysis is done. You want to dig deep into the company's financials, understand the competitive landscape, the industry it works in, and most importantly, validate the insights you gather from various sources. Validating your investment thesis has 4 sub-steps, and if you are watching, I'd highly recommend you make notes because you can internalize the learning from this video and make it your own practice when you're analyzing stocks. So back to step number 5, which is validating your investment thesis. As I said, it has 4 sub-steps. You can start this by analyzing the financial statements, the income statement, balance sheet, and cash flow statements, which will provide you insights on the company's financial health and performance. Then complete an industry analysis. Understand the broader industry trends to assess the company's position and growth potential. Then meet with managers and customers. If it's a company you have access to, for example, you might have shortlisted a bank or a customer of a bank. You can make an effort to talk to the bank manager to understand the inner workings of the bank, to give you that much of an edge in your research and in validating the information that you've already gathered. And then finally, compare the stock with the competition. Benchmarking it against its competitors will help you identify its strengths and weaknesses. So I know this is detailed, but stick with me. So once you've validated your investment thesis, we're now on to step 6, which is writing a brief story about your stock pick. Most people, when they buy a stock, can't answer the question clearly. I am buying this because. Lynch emphasizes that a strong investment thesis should tell a clear and compelling story about the company. The story should be easy to understand and communicate. Lynch believes that if an investor cannot explain why they own a stock in a few sentences, they likely do not fully understand the investment. So the story doesn't have to be poetic, but simply writing down about half a page of notes, sharing your investment thesis will not only give you instant feedback on how much you actually understand the business behind the stock, it'll also help you clarify your thinking, and maybe it'll give you a few other things that you might want to look into before deciding to buy the stock. Let's continue. Now we're on to step 7, which is determine the stock's valuation. So this is an art and science. There are many calculators out there you can use to determine a company's valuation. I'll link them in the description that you can use. Valuation is making a judgment on all the cash a business is going to produce between now and say 10 years from now, and discount it back at the rate that is appropriate, and buy it at a lot cheaper than that. Sounds complicated, right? In all honesty, it is. Conducting true valuation is challenging. A caveat here: most people on YouTube or other social media, particularly retail investors, they are screening stocks. If you just look at a number of ratios and decide to buy a stock, that's a fair way to go about it. But what you're really doing is screening a stock and then making a decision. You're not truly conducting a valuation. The approach you use is up to you. I just like to be intellectually honest. A lot of people I see online say, I value this company XYZ and this is the valuation. What they've really done is just screened a stock versus actually conducted a thorough valuation. All right, we're getting closer to the end. Step number 8 is to be patient. The legendary investor Charlie Munger, who said, money is made in the waiting. all throughout the book, Lynch too talks about the importance of developing emotional discipline and taking a long-term view. In order for your stock picks to become multi-baggers, you have to have a long-term perspective and wait. Which takes me to the next step number 9, which is monitor your stock picks. So you picked a stock and bought into it. You're willing to wait and be patient, but don't forget to continuously monitor and reevaluate your investments. Lynch says we need to regularly review our stocks and ensure the original investment thesis still holds true. And finally, step number 10 is to manage your risks. Lynch talks about the nature of investing is risky. However, we can manage that risk by diversifying our stock picks, conducting thorough research, and staying disciplined. He stresses that investing should not come at the expense of financial security, and one should not invest money they cannot afford to lose. So I hope you found this video to give you a clear step-by-step formula for picking stocks. Go ahead and try out these steps and let me know in the comments what worked and any questions you might have. I know it was detailed, but this is what it takes to pick a winning stock, to do the necessary work to be able to come to a decision that yields us good results. If you found the video helpful, please hit the like button and subscribe to my channel, and I will see you next time.